Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our very good friend, Sam Clement. Sam, say hello.
Hey, John.
How are you doing today, my friend?
Doing awesome. How are you doing?
Listen, I'm doing pretty good. I'm not sure the whole holiday spirit is completely upon me, but it's more upon me now than it was just a few short weeks ago. How about you?
I'd say the same. It's starting to feel a little bit more real now that it's getting cold, and even though the year's gone by so fast, it's time to kind of focus on
Yeah,
Christmas time, I guess.
that's so weird because this year has been one for the books, literally and figuratively. And here we are. In a lot of ways, it has drawn out. And in other ways, it's kind of like, I can't believe here we are already at the end of the year.
Yeah.
But even so, those people feeling the holiday spirit, it's beginning to look a lot like Christmas, all those good old tunes. Sam, I would imagine you would be filled with much more holiday mirth, glee, whatever you want to say, good tidings to you and your kin, if only, Sam, you had purchased some Airbnb, perhaps some DoorDash, Sear, Snowflake, and some of the other really hot IPOs out there this year.
Yeah. Fun fact about the Airbnb: if you were a host, you got allotted some of the pre-IPO shares. So I guess it paid a little extra to be a host this year.
I guess it did. And I'm sure with all your guests coming in during COVID pandemics and whatnot, gee whiz. I mean, what could the market capitalization be really, truly on that? I mean, I can't even imagine. What is it? Maybe the same market capitalization as the local.
Yeah, FedEx.
What? FedEx? No, Sam, you can't. You got to be kidding me. All Airbnb does, it's just an app or something that connects buyers and
intermediary.
sellers.
Yeah, it's an intermediary between people who have homes and people who need short-term rentals.
So, are you saying that really that's all that is, and yet they're worth more than FedEx?
I am saying that.
Well, certainly they can't be as large as Marriott or Hilton or something like that. These are people with big bricks and mortar, lots of real estate. Sam, that's the old economy. These are hotel chains. They've got thousands and hundreds of thousands of rooms and employees around the world. Certainly, they have to be worth more than Airbnb.
Yeah, Hyatt, Hilton, and Marriott, you'd think. But in fact, Airbnb is now worth more than all three of those combined. So,
Sam, come on, that doesn't make any sense. But is Airbnb making a lot of money?
No, they're not making really any money.
So if they're not making any money, how are they worth more than FedEx, who makes a lot of money, by the way, and worth more than the three largest publicly traded hotel chains combined? What's going on, Sam?
It's a good question.
I mean, you're the young person. You're the Gen Z. Here I am, the increasingly old and out of touch Gen X. I mean, instead of OK Boomer, it's going to be OK Xer coming up, not too far down the pike. And I just don't understand what's going on. Didn't you tell me, Sam, that DoorDash is now worth more than Yum Brands?
Yeah, it's worth almost twice what Yum Brands is. It's valued at just shy of what General Motors is. And these are companies with real assets, not a company that has decreasing profitability as they get larger. Well, lack of profitability they continue to lose more money with not a great sign or path towards profitability, yet they are now worth more than Yum Brands, who is one of the largest restaurant providers across the globe.
So you mean that company that has that app on my phone that, I pay a $1.99 service charge to get Thai food sent to my house? They're worth more than Yum Brands, which, if I'm not mistaken, includes Taco Bell, Kentucky Fried Chicken, and even Pizza Hut.
Yeah. Three of the largest, most well-known chain restaurants in the globe, and apparently it's not as valuable as the company that has just razor thin margins, if you want to even call it that. But the US, for example, has about $300 billion worth of money a year spent on food that's delivered, so food not in restaurants, and that also includes companies like you mentioned, Pizza Hut, but also, Domino's, the other pizza providers that have their own kind of in-house delivery. So
this doesn't make any sense. Why wouldn't Pizza Hut just spin off its delivery services and be worth billions more than what they are now.
It's not a bad idea. Throw in the word blockchain or cloud computing services, and then
cloud computing pizza.com.
Self-driving pizza cloud vehicles, and now
and
$1 trillion company.
It's absolutely ridiculous. Taking a look at some of the returns Airbnb have had. They just came out on December 10th. And it's already up over 85%, being valued ridiculously. C3.ai. I don't even know how you pronounce that. That's another one that's come out. DoorDash, big move. Sear, big move. Canate, Biopharma, all these. Sam, it's just the IPO market seemed dead in the water early on in the year, and now all of a sudden it is exploding like I have not seen it since really the tech bubble.
Well, you look at companies that IPO'd last year, or even better, companies that didn't IPO last year that had planned on it. So Uber did IPO, and they kind of fell flat on their face, and they ended up getting valued around what, investors had expected years before. They had already valued them at years before, and then they go public and it's even less than that after a few more years of growth. So obviously they fell flat on their face. Then you have companies like WeWork, the office rental space company, who goes from being valued at over $40 billion, $50 billion, some said upwards of $80 billion, to now being worth less than $10 billion and having to pull their IPO because there was absolutely no market for the garbage that it was. However, now you're having
How do you really feel, Sam? How do you really feel about that?
Now you're having companies like Snowflake, which we mentioned earlier, the cloud software company, worth more than Goldman Sachs. They are trading at 200 times revenue. You have Palantir trading at 50 times revenue. A lot of these too are companies that have been around for a while. Companies that have been around for a while and are not profitable and have not been profitable and don't really have a good path towards profitability. And it's not even like they're a new company. Some of them are, but some have been around over a decade with no profitability, yet we're seeing them trade at 10, 50, 200 times their trailing 12-month revenue. And it's hard to comprehend. And it's something we haven't seen since 1999. We've seen more IPO companies over double in their opening trading this year than we had in the past 20 years, or post 2000, so 19, 20 years. It's not normal is what I'm getting at. It's not.
No, it's not normal, but it seems to happen with some regularity. Now, Sam, way back when, and believe it or not, I'm a little bit older than you are.
Just a few years.
I was actually in the industry during the late 1990s, and frankly, I couldn't put my finger on it. It just didn't make any sense. There are a few names that it didn't matter what happened. They just went up in value. AOL.com was one of them. And, that's relegated to the dustbin of history, AOL.com. It's in there with members only jackets and Cabbage Patch Kids. Well, Sam, you might not even know what those are. But,
I do, actually.
but in any event, all you needed to have was a line of credit and .com someplace in your name, and your money was doubled, tripled, quadrupled, whatever. I remember back at a previous employer, I went over to Atlanta, Georgia, and during the first quarter of 2000, and to talk to this individual that a private banker over there had hooked us up with to come up with some kind of strategy for all the shares of his internet company that this individual had helped start, and he was the head of marketing or something like that. And this company, I'm not going to tell you the name because who knows who's out there listening. But the company itself had, Sam, if I'm lying, I'm dying, maybe $1 million worth of revenue. Maybe. Clearly no earnings. And it was market value $10 billion.
Yeah.
I mean, just something. I mean, no one really knew what they did. All that they did something with technology and had some kind of online something or another and blah, blah, blah. And I went into this guy, and this guy was looking for advice on what to do with all of his options and shares. Some of them were free to sell and some of them were restricted. And I looked him straight in the face and I said, you should sell whatever you can. Just go ahead and knock it out. And you know something? He was furious at me, absolutely furious at me. He had bought into the, drinking the Kool-Aid, I guess the best way to put it, bought into the, baloney. That's one way of putting it. And he kicked me out of his office. However, what happened by the end of that year, and, certainly by the end of by 2002, that gentleman would have done very well by himself if he had just listened to my advice, because, it doesn't matter what you're selling. If you were trading at $10 billion market cap and you have $1 million in revenue and you're bleeding red ink, it's going to take a huge amount of growth.
For a long period of time.
A huge amount of growth for a long period of time in order for the valuations to start making sense. And the same thing happened with Amazon. Amazon started out in the early, late 1990s, it went up and up and up, and then it fell like a stone. And it's hard to imagine that now. But when they started, it was like a bookstore, online bookstore.
Yeah, it was online books.
Yeah, and that's what they did. And everyone came out and bought it and blew and went the other way. But now all of a sudden they diversified and the growth is catching up, and it's still slightly elevated in price. But when I see these crazy numbers, that's what it reminds me of. It reminds me of the tech bubble. DoorDash at those prices, Airbnb at those prices. And the thing is, there's nothing to these companies. There's no tangible value.
Yeah, a lot of them, the bigger they get, the more money they're going to lose. Currently, they don't have increasing return, really. Their margins are going to get smaller and smaller as they get bigger and bigger, and a lot of that is due to the line of business that they're in. And so if you're not making money now, how are you going to make money 10 years from now?
Well, what really truly are the barriers to entry in either of those markets?
Not a lot.
And then that's the problem. When you start seeing valuations like this, just like we did in the tech bubble, regardless of technology was neat, we all knew that the internet was going to forever change our lives and how we conduct business, all that good stuff, just like cell phone technology and apps on phones, all that's changing our lives and how we conduct business. But at some point, you just kind of sit there and go, well, that doesn't make a lot of sense.
Right.
It just doesn't. I'm not really going to buy a dog over the internet. I'm going to hit a button and a dog will appear in my house. I'm probably going to want to go take a look at the dog, Yeah. So what do we have to do as investors? And understand, we have to put a caveat out there that we currently don't make a market in any of the names that we've been discussing, nor are we holders either directly or indirectly of any of them. What do we, as an investing public, really need to take a look at so we don't get caught up in hype that is an Airbnb or DoorDash, or that all of a sudden we're just not FOMO, fear of missing out on a trade?
That's a lot of it, and really the majority of it, because you can pick whatever valuation model you want for a security, and none of those are going to equal the valuation that these companies have. No expected growth rate, even from the company's execs themselves, are going to equal the valuation of these companies at this current level. However, it kind of brings up the greater fool theory. If you want to buy it now and you think someone else is going to buy it from you for even more, people are saying, why not? It just keeps going up. I'll buy it. Who cares what it's worth now? Someone else is going to buy it for 50% more in a couple weeks. That's easy money. That's what people are seeing right now. I mean, people obviously aren't caring about valuations anymore. You're looking just at like I mentioned, about the percent of revenue or the revenue multiple on these companies. And it's something that's just never going to add up. It's never going to make sense.
One that came out today, ticker symbol WNW, West Nancy West, or West Northwest would be another way of putting it. Wunong Net Technology, up over $100 in trading this for today. Sam, I think that we might need to change the name of Oakworth Capital to Oakworth Capital Net or something.
Oakworth Cloud Capital.
You think that would help? I mean, do you think it would be more attractive? You think it would generate that much more business? So that's what's so confusing to me about it, is here at the end of the year, we're throwing these IPOs, we're just throwing money at them, just absolutely throwing money at them. And this time last year, IPOs were falling flat, and clearly earlier this year, I mean, a lot of things were had a difficult time. But Sam, why now? Why now, and why to the degree?
There's just more money now, and there's we're in a low rate environment, and low rates have always, pushed people to go out a little more and take more risk. And because there's not the same level of returns in the current risk environment that they were in, kind of to put it simply. So what they do to generate that same level of return that they're comfortable with, they have to go out and take more and more and more and more risk to try and generate that same level of return that they could previously with lower levels of risk.
Well, I'm going to tell you a company that really has benefited over the last 12 months, and you remember this one, their IPO came out of the gate. People were all very fired up about it, and it kind of fell apart pretty quickly, and that was Peloton. You remember that one?
Yeah.
And we kind of laughed about that Christmas ad they had last year. Remember that? They had the very attractive woman who got the Peloton for Christmas. I guess her husband wasn't encouraged enough by how attractive she was. She needed to lose even more weight off of her size 2 figure. But that people just laughed at that ad, and the stock price did nothing. Absolutely nothing. And here we are. Sam, COVID really helped this particular IPO, I guess, because people can't go to the gym, so people are buying Peloton. And here we are behaving as though it's just recently went IPO. So that maybe some of the IPOs that we've seen will eventually come around. Do you think so? Or do you think some of these really just have no chance of ever catching up?
It's just hard to imagine that they ever, achieve the level of growth that's kind of built into these prices. I mean, you're seeing newly valued public tech companies trade at a median of over around 28, 29 times the revenue that they reported in the 12 months previously going public. And during this whole last decade, I mean, the average of that was around 6 times revenue. So you're seeing 4 or 5 times what the norm is for these companies that go public right now. And that's compared to, the NASDAQ index trading at 4 times revenue, a little over 4 times revenue. So it's not feasible, these growth rates. It's impossible, I would say, for most of these companies.
I would agree with you wholeheartedly, and particularly some of the ones where I've mentioned the lack of barriers to entry, and I'm just going to kind of pick on DoorDash. Nothing against DoorDash, the company. I use it. I use the service really to get Thai food to my house in a timely manner. I mean, we got Uber Eats, right? We have companies that already provide delivery service. And there's absolutely nothing keeping you and me, Sam, really from, if we wanted to spend the money, go out and create an app and go out and do it.
Yeah.
And when you're going
restaurants can do it themselves. Restaurants are doing that.
And so what's stopping that? And that's why people really need to be very careful. There are a lot of people out there that are very clever with their money, and they can get in and get out. They invested in DoorDash well before the IPO, and they're going to be selling their shares as soon as they get off, as soon as they're no longer restricted. And these retail people who went in at the IPO with all the hype are going to be stuck holding a bag of something. It may be money, but it's going to be a bag of something. Maybe won't be money, because here you are. It doesn't matter what industry you're in. If there are very few barriers to entry, ultimately your margins will go down. And if your margins were already razor thin, the next stop is losing money.
If your margins are super high, other companies are going to want to come in and do the same thing. And what that's going to do is lead to more competition, tighter margins, until it gets down to a point where new companies are no longer going to come in and somebody's going to cannibalize the rest of them with these low margins.
And that's the way it's supposed to work. However, with some of these IPOs, the margins are very thin, but the valuations are so high. What's keeping people from just, well, heck, I'm not going to make any money on the business. I'm going to make money selling the business. Yeah. So we're going to start seeing some more of that. And ultimately, I think some of these recent IPOs, not going to put any names on them. And again, we don't make markets in it and all that good caveat type stuff. I think they're going to come underneath some pressure.
I agree.
Just like we saw in the late 1990s, and then went into the new century, and things kind of fell apart. Fortunately enough, it's not system-wide yet, anywhere close to system-wide yet. But when you start seeing this type of stuff, I start getting a little nervous. Fair enough?
Right there with you.
All right, guys. Thank you all so much for listening. We always love to hear from you. Also, if you have any questions or comments, please let us know. You can always leave us a review on the podcast outlet of your choice, or you can just simply drop us a line at tradingperspectives@oakworth.com. If you're interested in hearing more, reading more of what we have to say or how we think, please by all means go to oakwood.com and take a look underneath the thought leadership tab. Sam, once again,
That's all I got.
that's all I got today, Tim. Y'all take care.